Your take on the session today? A pretty big gain, but also on some pretty low volumes.
Kate, that's exactly right. We did see a gain of 1.2%, but with just over $2 billion being traded on the market. Very low volumes, and that's no surprise given that today was a bank holiday in New South Wales, which means a lot of employees of not only the big four banks like CBA, NAB and ANZ and Westpac got the day off, but a lot of the investment banks were off as well, and that really explains the low level of participation on the market. But quite an exciting day for the material space. We saw the Diggers and Dealers Conference kicking off today in Kalgoorlie, and that will go on till Wednesday. So a lot of those material stocks in the spotlight. We saw presentations from the likes of Sandfire, Gold Road, Iron Ore Holdings and Evolution Mining today. Evolution Mining in particular in focus with a stock rise of about 5.5%. If we have a look at that material space, so one stock which went the other way was Lynas. It was actually down by 2.4% by the end of the day, and that's because we saw Molycorp, another rare earths miner in the US, actually down by about 29% during the US session on Friday after it came out with a surprise loss because of rising costs. But all up today was all about the material sector, the industrial sector. Rio was up by 4.1%, but on such low volumes it's really quite difficult to read anything into the market performance today.
Certainly some pretty ugly numbers, but are we starting to see all of this priced in now?
We did see quite a volatile reaction in Harvey Norman's shares when this announcement initially came out. And I think initially the market was just reacting to the quite dramatic numbers that profit before tax would be down about 39%, or excluding the property valuations down by about 29%. But in actual fact, I guess the market got used to the fact that this was already priced in. If you have a look at the Q3 numbers, that suggested a Q3 profit before tax of around about a drop of about 44%. So in comparison to that, I guess it was better than the Q3 numbers suggested. So all up, full year we are expecting to see a drop of 39%. If you exclude the property revaluations, we're expecting to see a drop of about 29%, but that's already been priced into the stock. Of course, a lot of Harvey Norman's attractiveness at the moment does come from that property portfolio, which has been revalued downwards. That property portfolio worth about $2.1 billion. It works out to be about $1.35 per share. And of course, Harvey Norman just trading below that $2 mark. So a large amount of the share price can be attributed to that property portfolio. So $1.35 and then minus some of the debt costs involved. So Harvey Norman, by the end of the session, we actually saw it up by 0.25%. And I think the market's really priced in this result.
Investment funds listed on the market. What did you make of these numbers today? It is an interesting one to watch.
And I guess it gives us a little bit of insight in what has been some of the big buys for this listed investment company. Now, this is a company that's been paying dividends for 66 years. It's got about $3.5 billion worth of assets. And if we have a look at some of the big buys during the year, the top three is ANZ, about 12% there, Challenger about 9%, and then Telstra with around about 9%. So you can see that decisively defensive tilt to some of the investments it's made during the period. Now, the profit was down by about 2.5%. But given that the ASX 200 index fell by around just over 11% during that particular financial year, not a bad result coming through. And we actually saw Argo Investment shares up by 1.1%.
And finally, Julia, I just want to get your take. Fortescue securing some new funding, which is always good to hear in this environment.
I think this was expected, given that not long ago we heard that Fortescue raised its capital expenditure forecast from $8.4 billion up to $9 billion. And if you include the Solomon mining equipment of $1.6 billion, that takes it about to $10.6 billion. So there had been a market expectation that it would need to raise about $1 billion more worth of debt. Today's announcement is actually more than expected, $1.5 billion. So it does give it a little bit of a buffer, which is probably quite good in this type of volatile environment. So a $750 million term loan and a $750 million revolving facility. Now, this is to help its expansion plans. It's aiming to get to 95 million tonnes per annum by the end of the year through Chichester, and then through the Solomon expansion to 155 million tonnes per annum by mid-2013. And I think by March 2013, what we are going to see some of the debt requirements really having passed, because they would have spent most of the money in terms of the expansion. There won't be huge extra costs, and in fact there will be some significant free cash flows coming through. The key here is the iron ore price. We're seeing the spot prices at about $116 a tonne, and of course if we continue to see softness in prices, well, that's going to be a problem for Fortescue share.